Welcome, everybody, to our championship edition of Greg Heym's Crossing the Line. Yes, the Knicks are world champions. Jalen, you did it.
Woo.
I gave you a lot of crap for not being a champion yet, but you are. You're the king of New York. Enjoy it. You deserve it. Your team deserves it. Mike Brown deserves it. And more importantly, we as fans deserve it. It was one of the weirdest playoff runs I've ever seen in my life, where you fall behind every game, and you get used to it. Just like, it's only 20. They can make that up.
It's insane. It was insane. Come on. But it's great to see that they can come from behind. You know, you're going to have to start worrying when they're leading.
I know that we won't know what to do. By the way, we have Professor Martha Stark, Esquire.
Thank you. Thanks.
The woman who's done everything. NYU graduate school professor, former New York City Commissioner of Finance. We have all-star guests when we have super, celebrations and championships. We got to have quality guests, and nobody's better at what we're going to discuss today than Martha. But I just have a little message for Adam Silver in the NBA. Your officiating is disgusting. And I'm saying this, and we won. The way Wemby was protected, how he can throw down Jalen Brunson in front of three officials who don't claim they don't see it, and then you review it and you don't think it's a flagrant foul, but if somebody shoots and you tip the little toe of the defender, that's an automatic flagrant. Would they have upped the foul on Brunson to a flagrant if they reviewed it? They would have had to, I would have thought, because that's like an easy call.
You know, it's so interesting. I was just reading this morning in the context of the WNBA that during the off season, the refs go and do like a sort of whole hangout with the coaches, and they review tape to see what calls they missed. And actually, they're being evaluated kind of almost every week. I don't know if that's true in the NBA too, but I'm got to suspect that it is. And really, really interesting how they're reviewing it and trying to sort of make themselves better.
Well, that roll of missed Wemby calls is going to be pretty long.
That's right. It's going to be interesting to see if they do that during the off season.
You know, this whole idea of trying to explain to my son what the NBA was like in the 80s. Mm-hmm. You know, he can see Charles Barkley. It doesn't look too scary now, right. But I'm like, if that was Isaiah Thomas and that was the bad boys, that Wemby would not have gotten out of the arena alive. Like it would have been back in those days. True. You didn't wait for the refs to step in. You handle that stuff yourself. Mm-hmm. You think of what Detroit used to do to the Lakers, what the Celtics used to do to the Lakers. It's amazing the Lakers survived, because no matter who they were playing, they were going to get roughed up.
Absolutely.
But congratulations, and it seems
Knicks.
Like, the parade is this week. It seems like people didn't get too out of hand. Because they read my column, I warned people. Like,
you said don't. You said behave.
Behave, and I said, because it was disgusting. It was disgusting after Wednesday.
No, it was.
Yeah. We have to do better.
Yeah, well, they did destroy some buses that were taking people to the World Cup in Jersey.
They were doing them a favor. It's soccer. We don't care. No, I get a lot of gruff for I have no interest in soccer at all. Sorry if we're losing. We've already lost anybody from Philly as viewers of the show, because I say enough about Philly fans and Philly teams.
Okay.
But I can't say that now, because 3 Villanova players just won us a world championship.
Greg, there you have it. Absolutely.
Well, why Martha is on the show today is we're going to be talking all about the Pied-a-terre tax. I know I've gone off about this before, but now we have a little more information. We're going to share some knowledge. We're going to throw some hypotheticals at Martha. She's going to straighten all this out for us right after these messages from our wonderful sponsors.
Do you have a big move coming up? I'm Scott Nadler with CrossCountry Mortgage, and I've got the loan to match your dream home. Whether it's your first or your fifth, I'll make the process quick and easy. Call me today. Let's make it happen.
Sedgh & Zuckerman is a boutique residential law firm guiding you and your clients every step of the way with a solution-oriented approach. Make sure to work with a deal maker and not a deal breaker. Contact us today at sznylaw.com.
So we're here to talk about the second home non-primary residence surcharge, or pied-a-terre tax, or whatever you would. Technically, it's a surcharge. That means something, and maybe we'll touch on that. But basically, this has been in one sense, it reunited me and Martha after years apart, like peaches and herb. We all of a sudden we were reunited and it felt so good. On the other hand, we didn't like it because we spent the last 7 or 8 years fighting this tax. Basically, somebody said, hey, we should tax people who can't vote us out, people who have a second home and have the nerve not to pay income taxes. And even though they don't use the services and they pay everything else, which 3/4 of the tax that the city collects is not income tax, and the property tax being the largest tax and the most reliable source of revenue they have. But that's not enough. That they pay more than their neighbors because they don't get exemptions. But now it's finally happened, and there's a lot of reasons to dislike this tax, and I've railed on most of them. But we're going to talk a little bit more about the nuances of the thing, how it works, what we still don't know. We got some rules issued. Martha, was Commissioner of Finance in the Bloomberg administration, so she knows all about this. So basically, it starts with you could do this one or two ways. Is it your primary residence or isn't it? Or what is the market value of this property?
Right.
And let's just talk about market value for a minute, because that creates a problem for apartments because of the way they're valued. Mm-hmm. They're not using a sales-based approach, right? So this is where we have two different rules. And why don't we go into that? 1 to 3 family, class 1 properties, $5 million market value. They use sales to value those, so that's pretty accurate.
Well, I don't know.
I was being nice.
Okay.
It's somewhat accurate. Mm-hmm. And co-ops and condos are valued as if they were rental buildings. State law prohibits the city from valuing them using sales comps. And that leads to grossly undervalued properties. So the threshold is $1 million. Mm-hmm. Now, did they do an extensive study to get to $1 million, or you think they just kind of, I know you were involved in a lot of these talks. How good do you feel that $1 million market value is close to a $5 million sale price?
So let me just sort of say a couple things. The first is that they did do some analysis, right? I mean, I wouldn't say a lot. I mean, I think that there was a kind of goal set up that, the city needed money, the mayor needed money, and why not actually bring this back from the dead. Basically, I thought it was dead and buried, but in 2019, but bring it back from the dead. And to do it in a way that really sort of targeted people, like you said, who don't live in the city and don't pay income taxes as well. I think it's important to also remember, the commuter tax and the commuter tax's demise. And so the city has for a while thought about people who do benefit from city services, even though you're right, like, they don't send their kids to school here as far as we know. And so trying to figure out how to kind of best do this. Okay, so what kind of analysis did they do? I think the state folks were looking at like sales prices and saying kind of what approximately is the assessed value.
And the state has to get involved because the city can't do a lot of these things on their own.
That is correct. They can't adopt new taxes on their own. And even the structure of the property tax is set at the state level, right? So they definitely needed authority from the state in order to do this pied-a-terre tax. And the 1 million threshold, I've kind of done a little bit of analysis on this. It's going to get some properties that are actually sell for $3 million. And it can get some properties that sell for as much as $9 to $10 million. So the $1 million assessment value threshold, I think the numbers that I saw, kind of at the median, it's around slightly less than $5 million, but above, it's definitely going to capture properties.
And the reason they had to stick with market values, they didn't have time to come up with a sales-based approach for these co-ops and condos in time because they want the money now.
Right. I mean, clearly the mayor needed money for this fiscal year in order to close what was a big budget deficit. He seems to, at least based on the numbers, he's managed to do that. But this $500 million estimate that they wanted from this tax was going to help in that regard.
Yeah, it usually does help, but when you're talking about your gaps in the billions,
Right.
It's like the MTA with a $70 billion capital plan. It's like, oh, the congestion pricing is raising, $100 million a month or whatever, and you go, okay.
Well, it's interesting because the city's budget is so large. I mean, it's over 100. It's almost $115 billion, and so I used to joke about this when I was finance commissioner, and people would say to me, well, but this would raise $200 million. And I would be like, well, it's $200 million of aggravation, and $200 million is a rounding error, which, on the city's overall budget, it's really a rounding error. So $500 million seems quite small in the scheme of things, but the governor wanted to provide some help to the mayor in this regard.
So to acknowledge that the market values they were going to use were not accurate on the co-op and condo side, and co-ops don't get individual values. The building gets a valuation, and then that is, paid through maintenance, and really based on the percentage of shares you own is the easiest way to talk about it. So they decided to do 2 phases of this.
Yes.
Phase 1, or the keep everything the same phase, where we just use the market, not the assessed values, the market values, that first number. And that's for the first 2 years. That buys them 2 years to come up with a sales-based approach to value co-ops and condos. The kicker is, for property tax purposes, they're still going to use the old system.
Yeah.
Because they're not changing that.
Yes, that's correct.
Which again uses rental comps, and it really they have to pick buildings in the area built roughly around the same time.
They actually don't.
They don't?
They don't have to pick buildings in the same area.
Doing.
No, they don't have to. And I do want to talk about our lawsuit, Tax Equity Now New York,
Absolutely.
because in that lawsuit, what we pointed out to the city was, one, they don't need to use regulated rents when valuing co-ops and condos. I mean, one of the issues was that they were using regulated rents, so it's no wonder you're going to get a lower value.
And that's why the co-ops, that everybody would say, that's why the co-ops are so undervalued, because they're older buildings, more rent-regulated units.
Exactly. And so that's a problem. Our court case and the Court of Appeals ruled 2 years ago that actually they could use market rents, right? And so if they were to use market rents to value those buildings, that would get you a better value. So I'm going to take issue with an inaccurate value. I think they arrive at what they thought of as a legal value, but they have more sort of flexibility in terms of getting to market rents rather than using really, really low regulated rents. Those values might get you closer to sales price and stuff. But yes, you are absolutely right. 2 phases. Phase 1, use finances existing market values. Phase 2, and you said 2 years, they really have 18 months because they're going to have to put those out by January of 2028, right? In order to actually fulfill.
Yeah, because they're going to have to, and again, they have to start notifying people this year by the end of August,
right?
Whether they pay. It's interesting though, because then when you hit phase 2, you're going to have 2 market values to challenge,
right?
Which is double the fun for the tax commission, because you do have the right to contest the values and your residency, right, with the tax commission.
Yeah, so interesting stuff about the tax commission. We're still awaiting rules from the tax commission. The Department of Finance has issued rules about the Pied-a-terre tax. The tax commission has not. And it's important to remember that actually the tax commission doesn't have jurisdiction over market values. The state law now gives them that jurisdiction, but they're going to have to tell people how they plan to do it, because they've not worked in market values. They've only worked in assessed values. And they know very little about primary residency stuff. So the tax commission had been primarily a property tax review sort of
you
entity.
go and you get like a 30-second hearing or whatever.
Right. And, they would say, well, okay, now we're going to reduce your assessed value, but they're not really the experts when it comes to primary residency, which, of course, is mostly done on the income tax side. So
right.
It's very interesting.
So we have phase 1, phase 2.
Yes.
And then this expires in 5 years.
Well, there's definitely a sunset in there.
There is a sunset. I don't think anybody buys that they're going to that this wouldn't be extended. And just to talk briefly about how this works, I'm sure most people know this that are interested, but we'll go over it. The threshold again for 1 to 3 family homes or tax class 1 is $5 million or more.
Right.
And if you're between 5 and 15 million, you pay 0.8%. This is annually. 15 to 25 is 1.05%, and over 25 million is 1.3% of the total market value, not over a threshold.
Correct.
This was structured differently in previous versions where you pay a flat amount and then what you're over. Co-ops and condos, we're starting at $1 million, so the tax rates are higher. 1 to 3 is 4%, 3 to 5 million is 5.25%, and over 5 million is 6.5%. Now, when we go to phase 2, nothing changes for class 1 properties. They're going to still have the same values. Then the thresholds will be 5 million and over for the other properties, which are co-ops and condos.
Right.
And, that's basically how it works. There are exemptions from this and ways you can avoid paying it. If, again, it has to be your primary residence or, and this is where it kicks in, there is a bunch of ors. So you can sell it, then you don't have to pay. Somebody else may have to deal with that. You can rent it. It has to be the primary residence of a tenant who has a bona fide lease of at least 1 year. You can't just charge your buddy $50 a month to live in the apartment. That's not going to work. Family occupied by a primary resident. Now, does that have to be an adult? I guess it does.
I don't think you'd
You'd
if
put
you
a
want
kid
to
in
incur
there?
the penalties, I don't think you can put the cradle in and have your
Have Junior in there?
6-month-old,
Well-
Well, you have Junior as long as Junior is kind of able to sign a lease.
The
So
interesting
you don't really need a lease for the family member.
The interesting thing, and that's immediate family. We're talking parents, grandparents, children, grandchildren. Sorry, nieces and nephews. We all love you, but
Yes.
you don't count. You think in the bill, this stuff would be laid out specifically, but as I always tell people going back to my Rebney days, there's the laws that get passed, and then there's the rules. Now, the rules have come out, which have not really proposed rules, I guess, this time to comment, that have not really got into some of the finer points of these exemptions. I've been getting a lot of questions and want to go through some of these a little bit. I know you and me have talked about them, but for the wonderful folks viewing the show that we love so much, people say, okay, let's say I have a primary residence in New York City. I just bought a new apartment. I'm renovating it. Can't move in yet. Work's not done. Is there a grace period? Seems like it would be reasonable to give people a certain amount of time, but this doesn't necessarily address the rules, and the bill don't address this situation. But we've talked about the idea of taxable status date, and we're going to get into that in a minute, because that plays a huge part in any benefits that get added or taken away. And now this is really going to matter a lot for buyers and sellers, because this tax will literally double a lot of people's property taxes when you think about it, what they're paying now versus what. And another example of why market value for condos is so messed up. Ken Griffin's apartment, $240 million, market value of $15.5 million. They're not saying that's what it's worth. That's what it's valued at for property tax purposes.
Right.
So in this case, we can't say exactly, but it would be reasonable to expect that maybe either you're going to tell people to time this around taxable status date, or is there any chance finance offers us a little more clarity on this situation?
So a couple things. One is, as you said, the rules have been issued, and you have until July 19th to comment on them. And so I've been working a little bit with the real estate board. And so we sent around draft sort of set of questions and examples for them to include as part of the rules. I think finance is looking at the rules themselves first, and then after they clarify a lot of the language in the rules, then they will put a bunch of hypotheticals in. And so if there are things that brokers and others are encountering and they want clarity, I think the best way to do that is to submit those as examples. And so the one that you just gave, interesting to think about it from sort of two vantage points. First off is, as you said, the taxable status date in New York is January 5th. And I just want to be clear, taxable status date is not a new concept. It's in the rules. I mean, so much so that those of us who've worked in property taxes before would say to you, if your house burns down on January 6th, the taxable status date is January 5th. If the building existed on January 5th, it burns down on January 6th, you're liable for taxes on that building for the remainder of the current fiscal year, which runs through June 30th, my birthday, by the way, and the entire following fiscal
cake from Martha?
year. I don't see it. I don't see it. It's June. It's in the month.
I'll get you a slice of cake at lunch. Don't worry about it.
So in any event, all of that to say, taxable status date is not a new thing. So people need to think about January 5th, though, as this date that's relevant. So again, the hypothetical that you gave, January 5th, so what happens on January 5th? Where are you?
What did you own?
Right. Are you in the old residence? If the answer is yes, is it above the threshold and possibly a pied-a-terre? Then you might be liable for pied-a-terre on that. Two planning things that you can do. First is, interesting, is it cosmetic renovations? Or is it a renovation that requires the issuance of a new C of O? Interestingly, because if you don't have a C of O for that property, there's an exemption. You talked about that there are some exemptions in the rules. So I think that, again, it's going to be great for people who help folks plan their taxes.
People like Professor Martha Stark, Esquire.
That's not usually what I do, but perhaps I should hang out a shingle and start doing that.
So the C of O thing is really targeted, it seems to me, for sponsor units in new buildings. Like they shouldn't have to pay pied-a-terre tax on units that haven't been sold yet. Somebody asked me in a sales meeting, a lot of older co-ops don't have C of Os.
Right.
Does that mean that they don't pay this tax? And I said, well, that's certainly not the intent.
That's definitely not the
intent. They're not unsold units.
Right.
They've been occupied.
Right.
But see, that's another technicality that somebody may think they could use to exploit this. But
right. And again, tax planning is not exploitation. Tax planning is planning, right? And planning within the, sort of existing rules in a way that's not fraudulent, but at least wants to understand what's going on.
So I know another thing you're
there.
going to suggest, because you mentioned this in regards to another part.
So the question of, is there a family member that can be in the apartment? If it's a married couple, is it possible to have one be its residence and the other be someone else's? So again, I think that people have to recognize that there's some planning opportunities around this that's not about avoiding the tax, but if the city is not going to recognize a grace period, they don't have any authority in the legislation, by the way, where it says you can recognize a grace period.
Right.
So you also don't want them to expand the rules further than there or curtail the rules from the law. So, for example, I think you had a question about trust or estates. I think if somebody dies, right?
Right.
So interesting, when I was in law school, when you took a course, it was always a trust and estates course because you always thought that the estate usually created a testamentary trust, right? That's what happens. The rules or the law doesn't talk about estates, but they do talk about trusts and LLCs and how to sort of handle them. So in any event, all of that to say, I think there's huge opportunities for people to provide finance with, here's the kind of situations that we're actually encountering, and we need guidance about how we should answer those questions.
Right. And, a lot of brokers have come up to me with these questions. Right. What do you mean it's not in the bill?
Right.
It's like, because they don't think of every scenario.
How could they possibly?
And, with the question is, too, with the renovation, if I'm going to buy something I need to renovate, then, I'm going to buy it after January 5th. So I have a whole year almost to get those renovations done before the status could change, right?
Right. I do think it's, it's a question of planning. I mean, not-for-profits used to have to do that too, right? It's like if you buy before the taxable status date, then, and you're an exempt entity, you get the exemption. If you don't. So, I mean, I think those are the kinds of questions that people have to be thinking about now is what
And this
date
leads
am I buying?
to what could be a negotiation. I'm buying your apartment. You're paying the tax.
Right.
I'm going to be a primary resident,
Right.
but it's January 7th. And then I'm told by my lawyer that, oh, you're not going to be able to take that off until a year from January, which means you're going to pay
a year and a half. It's really 180
right. Well,
days,
yeah, you
right?
take it off, but then it will start a year and a half
Right.
when the fiscal year begins July 1st.
That's correct.
So I'm going to have to pay the Pied-a-terre tax. So I'm going to want a concession, and we're going to have to talk about it, right?
I
That
think
makes
that's
sense.
Right. I think that's what people are going to have to do. And, usually lawyers doing closings don't at all think very much about the property tax side. It's always been, sort of a pet peeve of mine that the people are in real estate practices at law firms know very little about the property tax, and the property tax is thought of separately. They're going to have to start talking to each other because a lot of deals are going to turn on what's going on here with this tax/surcharge.
So with the estate, it's really going to come down to taxable status date and how long that gives you to sell, because it could be on the hook for it, right? I mean, if the person is passed and you can't put another family member in there.
Right. If they do not figure out or at least kind of cover the estates in the trust rules, which, by the way, one of the reasons I talked about the rules can curtail authority or kind of give more authority. The rules as currently drafted, if I read them correctly, the Department of Finance actually changed what qualifies under the trust rules, right? They changed it so it's got to be a sole beneficiary, and the actual law said a majority. So if you could imagine a trust that's set up for 3 people and one has a 60%, the law said that person, the 60% person, could qualify for this exemption, but the rules say a sole person, so it has to be one person. So things like that, and that will just lead to litigation. I mean, all of this may lead to litigation, but if finance is not careful about making sure that they're not exceeding their authority under the law, it's just going to further complicate things and make it really difficult.
Well, further complicating things was the issue about rentals. And I did a sales meeting downtown, and they just kept throwing scenarios at me in ways. So again, it's got to be a bona fide lease. I can't rent it to somebody at a ridiculous amount. But then the question came up, what happens if during the fiscal year someone has to move out, they lost their job, they change their primary residence while they're in the apartment?
Yep.
I guess, or if somebody passes on, it's all about
that
January 5th and what happens there. They're only going to check once a year.
That's what it sounds like. I mean, look, we're not sure how they're going to even do once a year, right? We're not very clear about.
I don't think they're sure either. So.
Right, exactly. So yeah, that date is really telling. So if as of January 5th, the person was still alive, it was their primary residence, it's going to be exempt for the period of time that kicks off their following fiscal year. So that date's going to be really telling. And
on the flip side, if your lease commences January 6th, too bad, you're going to have to pay that year.
That's correct.
And then you're going to have to wait.
So can I another thing actually, and I because I've been looking at this probably far too much. I mean, not watching enough of the Knicks game. I only tuned in for the third and fourth quarter.
Don't worry, the WNBA playoffs haven't started yet.
Yes,
okay.
Right. But the Liberty are on a 7-game winning streak. I just want to put that out there right now. So, and they're going to play representing the East in the Commissioner's Cup. Okay. All right. Now, back to the Pied-a-terre tax. So one of the interesting things is, okay, this year, this isn't a problem, right? So, but in future years, it is. Because if you have to prove primary residency on January 5th, I was a resident of New York City, and I paid income taxes in New York City, but we don't file our income tax return until April 15th, if not extended till October 15th. So that's a whole nother dilemma. Are we going to use, and I certainly would say, if someone has a tax return with that address on it, showing that they paid New York City income taxes, that's their primary residence, but they're not going to file that return until later in the year.
Do the rules mention it has to be for the current year?
Well, what other year would you?
Well, like
have it be?
I was thinking that when DOF collects income and expense data on properties, that lags.
That's correct. But that's an intentional lag so that they can value property. But if the primary resident, you want them to be primary residents as of January 5th, you need their prior year. So let's take this year, 2026. I need your 2025 tax return in order to sort of suggest that. I mean, of course, you could have moved, but that's a whole nother sort of area that's not covered in the rules.
Well, they could also require it by April 15th or something. But as you pointed out to me a bunch of times, they don't like to do things in the middle. Once that date passes, nothing will change. And it's like the co-op condo abatement. You know, you have to wait.
Right. Well, also they're, issuing an assessment roll on January 15th. So you don't want to wait till April 15th to know, am I liable for this or am I not? So anyway, lots of things that folks didn't quite think through in putting this together.
And one last scenario that keeps coming up, we've kind of told the solution to this, is somebody owning multiple units in a co-op. What can they do about that? Combine them for one thing, or put one in a family member's name or a spouse's name or something like that.
So, and also the question in a co-op is it below or above the threshold? So do they own 3 units with assessed values greater than $1 million? I don't know, but depending on that. So, first question is, am I actually potentially taxable before you start thinking about how do I actually plan around this?
And remember a couple of things, because we've had a bunch of agents call me and say, well, I know it's $1 million market value, but we're buying this apartment for $5 million. Mm-hmm. So what does that mean? I go, what you're buying it for, it means nothing for the first 2 years.
Right.
And, we use words market value and assessed value. They get used kind of interchangeably at times. Assessed value, which is a percentage of market value, has no bearing in this tax.
None whatsoever.
None whatsoever. So when you go to the DOF's website, you want to look at the current market value for this year or the upcoming year.
Right.
And the top line number, estimated market value. Ignore everything below that for 2 years. If we're talking about co-ops and condos. But even with single family homes, just because you paid $5 million for it, that does not mean that's what the market value is going to be. Mm-hmm. It's certainly considered a sale, but just like an appraisal doesn't always come in right at the sale price, market values aren't going to come in at a sale price either.
Yeah, and also, we talked a lot about the co-ops and condos where the $1 million isn't reflective of what the sales price would be. It's true on the housing, the 1, 2, and 3 families as well. The $5 million that finance says might not be what you might actually have a $3 million property. Right. And so you need to sort of think about that as well. Heretofore, if you are 1 to 3 family home, you never looked at your market value. You didn't challenge your market value because your assessment is only at most 4% of your sales price. So,
and this goes to something that your group has talked about when you talk about an inequitable tax system, is this cap on assessment increases that's why townhouse owners, especially in the more expensive parts of New York City, can't challenge the taxes because there's an implied market value based on the caps to their assessed value.
So I'm just going to say our lawsuit said the city has an obligation to have a uniform assessment ratio. So they have to stop saying it's 6%. It's not uniform at 6%. If I have a $100 house, I'm not assessed at 6%. So they can actually have a uniform assessment ratio by lowering the ratio to $3 or 3%. So we don't blame the caps. The caps are a feature of the tax, but it does not excuse the lack of uniformity that the city actually controls. The city, nobody told them 6%. They have to decide what would lead to uniformity so that a $100 house pays or is assessed at the same amount. So I'm just gonna, I just because it gets
No,
me
you got to hit them with the
crazy,
not. Well,
get
you know what?
crazy. Yeah.
On that note, we'll take our last break so everybody can calm down and shake their heads and get some caffeine. We'll be right back.
This beautiful set here at Studio 1873 is brought to you by the Everset. The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
And we're back with my good buddy, Martha Stark, talking all things pied-a-terre tax. So there's so many things about this that are, on its surface, it seems somewhat easy for now. There's a DOF market value. I can look it up. If it's a 1 to 3 family home or a condo, I can find it specifically for my property. What's the value? I have the right to contest it. I have to prove primary residence. Pretty straightforward. Co-op side, not so much, because the building gets a value, right? And then it would be a portion based on this percentage of shares. So if you own a co-op or you're buying one, the way to look at it is look at the market value for the whole building.
Right.
What's the shares in the unit? And then divide that by the total shares of the building. So if you own 10% of the units, you own 10% of the market value. Think of it, they are shares of stock.
Right.
If I own 10% of a company, it's worth $100 million, I have $10 million. The problem is, and a famous real estate attorney mentioned this in the Real Deal article, that boards don't have the authority to do what the city wants them to do, the co-op boards. You know, they're going to have to amend their proprietary leases. Because the question is, me and Martha live in the same co-op. I have pied-a-terre tax liability. I don't pay it. Who pays? The co-op pays, right? Because that's who they're billing.
Right.
I don't own real property. The co-op does.
So I think some of this is a little overstated because some of the proprietary
Did I
leases-
overstate?
Not you. I was going to say just some co-ops can implement this with no problem whatsoever. Others, I shouldn't say no problem whatsoever. It is concerning how the co-ops are going to do this because, as you said, ultimately the building's liable for the tax, right? But I don't know that the proprietary lease in all buildings would limit a co-op's ability to actually collect this amount. So, for example, co-ops are doing all kinds of things in terms of the co-op condo abatement, right? If it's not your primary
They're not necessarily
residence,
giving the money
That's correct.
Back to the people.
That's right. I just got my annual co-op letter where the board said, we're keeping the money from your co-op condo abatement, even though there's 2 or 3 people in the building who aren't entitled to it. They're going to actually have to pay, but you're going to have a slightly lower sort of maintenance this time. So co-ops are accustomed to at least saying, you, Greg, have to pay more because it isn't your primary residence and others don't. So I do think that part is slightly, do they have the authority under the proprietary lease to do it or not? A little bit overstated. Nonetheless, it is an issue for co-ops if people don't pay it because it's going to ultimately be shared among the people for whom it is not a pied-a-terre. And so that needs to be worked out and ironed out in some way in the rules. And, it's great that the city's hiring the co-ops as their collection agents on some level, but it's
managing
really,
agents don't have enough to do. And,
right. So yeah, it's going to be very interesting to see how that sort of plays itself.
There's a couple of other interesting things here. Number one, will co-ops change their rules to either limit pied-a-terre ownership or increase subletting or both? Because if they don't want to deal with this potential issue.
Right.
The other problem, and we're not going to know this for 2 years, so you're going to go from the market values based on rental comps to actual sales-based approach of valuation. What is that going to do to taxes for property? What does that do to Ken Griffin's property? What does that do to co-op units?
So, it's, again, I think all of this is very complicated, although most people have always sort of said, well, you should use sales prices for co-ops and condos to begin with, right? That is, a better way to value. I actually think that there are 3 ways to value. You can use cost, you can use sales, you can use income, all legitimate ways to value. The question on the income side is use the right income estimate. Don't use an estimate that's too low. And, it used to be that, at least I was taught by mentors, that those 3 should reconcile themselves. So a couple of things to remember. So when you say use sales price, I don't think that the sort of goal is, oh, by the way, let's lift everybody in Ken Griffin's building up to 238 million, or at least 238 million based on whether it's square footage or some other sort of thing. I asked myself, is the Ken Griffin sale a sale between rational buyers and a rational seller, right?
Well, I think everybody's rational. They have to be to have that much money.
Well, I just mean that that's not how market value is defined for property tax purposes. And so that's going to come into play. I mean, I might just say, well, maybe Ken Griffin wanted to have the highest market value kind of in the city, in the country, and that's why he bought that. But in any event, all of that to say, the city is going to have some work to do in order to convert or calculate these market values. And the question is, are they only calculating it on the units that are pied-a-terres, or, as you said, for the co-op, they have to do it on the whole building. Not
so how do they get that value for the whole building? What do they know about the units other than the shares? Well, they don't.
They know shares. They know some stuff about the building, but again, I'm not saying this is an impossible. I think it's a Herculean task, and the notion that they should have this ready to go by January of 2028 is really asking volumes from an agency that doesn't, in my opinion, even follow the law that's laid out that says assessments should be uniform, and that you can value co-ops and condos even using market rent. So it's going to be a Herculean task, and we'll see how they do.
And as we get more information, we'll continue to give you answers to hypothetical questions. And if you do have any rule changes or any things you'd like to get cleared up, you can send them to ctl@bhsusj.com. We'll forward them to Martha. She's better at this stuff.
Greg calls me all the time. I just also should say that in the next day or so, I kind of created a little bit of a tool that people can use where, again, this is not legal advice. It's just a tool that can help you kind of take a look at a couple of things. One is, am I likely to be hit up with this? But second, also takes a look at, is it your primary residence? And then if you say no, here are some things that you can do. But even if you say yes, here's the documents that you could
you don't need to know anything about how this law works, because it's asking you the right questions. It's kind of like what TurboTax does when you do your taxes.
That's exactly right.
Do you own one of this? Do you have?
That's right.
Do you work in Yonkers?
That's right.
That's always my favorite.
And so
question.
it's going to launch actually in 2 places. One on the Real Estate Board of New York's website, but also on my little small law firm's website, starkpatchlegal.com. So stand by for it, and feel free to use it if it's helpful.
Yeah, and you know what? There's still, until those letters go out at the end of August and say you owe this much money, we're not going to have a definitive answer. But the guidelines that we have give us enough information to have a pretty accurate amount.
Yes, absolutely.
Specifically with the single families and condos, that we can pretty much be sure of. It's the co-op, and because there's commercial space in co-ops, and that could have a little factor or not on what your percentage of ownership is.
Yeah, I mean, share allocation is really complex. It's not as easy as people think. Some people do it based on square footage, but if you're in a very high floor with a fantastic view, your market value might be a lot higher, but your share representative might be much lower. So it's sort of interesting, especially because as developers decide how they're laying out shares or common area percentages, it's going to have a huge impact on how this works.
And, there's always the uncertainty. Now this bill, I think we saw the actual bill like 2 days before it was passed and signed. And, the rules have just come out, but everything has happened so quickly, even though this has been going on for the better part of a decade.
Right.
And we were able to convince the last go around in 2019 that this was a bad idea for a variety of reasons. Number one, it's a very avoidable tax. And, the revenue it's going to raise is very unpredictable because, when it's top weighted, although it's not as bad as I think the original bill where Ken Griffin was going to pay a couple % just by himself. I think that, they were looking for $500 million, and then the controller looked at this and said, maybe as little as 340 million or so. And then they put out this thing now that it could raise, $1 billion. And then it's the fine print that doesn't show up fast enough because it's this idea of a notional amount. Like, I have notions all the time, but it's not about hundreds of millions or billions of dollars.
Yeah, I do think that there were some shifts that were a little bit surprising. I think that the burden now is really on the taxpayer to sort of say this is really my primary residence, right? Before, the assumption was things like, for example, if you receive the co-op condo abatement, that you would be presumed, it would be a presumption that it's your primary residence. If you receive, most folks at this level don't get the STAR exemption or senior citizen exemption or anything kind of like that. But if it was held in your own name, there was an assumption that that's probably your primary residence. And then there were even some LLC tests, right? So one of the areas that we were concerned about is if you own as an LLC, are you actually presumed that it's not your primary residence? And that's why the LLC rules were actually probably the best part of this bill, because they at least sort of gave an avenue for even an LLC to get this sort of tax.
It's a good point, too, about the co-op condo abatement. If you're receiving this, that does not mean you automatically it's your primary residence.
That's right.
And if you own an LLC, it doesn't mean automatically it's not your primary residence. Correct. That's where the whole idea of natural person comes in.
Right.
And this is stuff that, people make assumptions like, well, finance has always done it this way. Finance has always done it that way. But the bill actually did talk about LLCs and trusts and what the requirements had to be. I think it's interesting, though, that it's like, well, we think based on how many properties we've identified that it could raise as much as $1 billion. It's like, wow, $1 billion. That's a lot of money. And it's like, or as little as, $340 million.
Yeah, no, and I think that that's correct because, and the shift to me is the burden's now on the taxpayer.
Yeah, guilty until proven innocent, Martha.
That's
I don't
exactly
think that's what they taught at law school.
That's, let's not do the law school thing. But no, it's a real dilemma. And so it creates an administrative burden that's going to be costly for the city to sort of figure out and to have people come forward. I just will say the tax commission still deals in paper. Right. I mean, they're a paper driven. You file your application, it's in paper. And so the notion that they're going to be able to do these primary residence challenges is, yeah, it's really interesting. And they said they don't think that they actually need to issue any rules or regulations about it.
Nice work if you can get it sometimes. So over this 10 years, almost that we've been fighting this test, it's funny. We were able to make a good argument to an administration that was listening, in 2019, saying that, this is not a good revenue for you because it's so unpredictable. You have transfer tax, you have mansion tax, predictable, consistent one-time taxes that will cause an adjustment in the market. And it shows you that, do people respond to tax changes? Well, just remember this. When they raised mansion and transfer taxes in 2019, the June, because the fiscal year ends in June, was the best June we had ever seen for closings by far, because everybody wanted to get in. When the federal capital gains rates changed in the Obama administration, I believe, we saw the greatest December ever. So it's funny that some governments, it's like, oh, we don't want people to smoke, so we're going to jack up cigarette taxes to get you off that. But they don't expect the same thing may happen with anything relating to property taxes or levying second home taxes.
Yeah, I think, again, I don't mean to excuse it. I do think that there was, and even some of the dialogue that we're having here, there's some, you talked about Ken Griffin's taxes. The mayor made a big deal about his taxes in a way that wasn't really, so cool, right? It's the best way to describe it. It wasn't really so cool. But what I was going to say is that Ken Griffin's taxes, you just sort of said, oh, he bought it for $238 million. The city has it at 16, 17, maybe it's 19 million this year. I don't remember. And that number is not quite correct, is how you sort of described it.
But is it significantly more than anybody else is paying? Because that's the true question. And that answer would be yes. Nobody's.
Yes, except that, the property tax is a tax on value. Whether you like it or you don't, it's a tax on value. And that tax on value, what I would argue, should be kind of equal across.
100%.
It shouldn't be Ken Griffin's taxes, $2,000 per $1 million of value, and somebody living in Staten Island or the Bronx is $12,000.
Well, those are
$1 million
effective tax rates.
No, I'm talking about just your taxes as a percent of your value. I'm not doing the rate. I'm just talking about take the dollar amount and say how much is that per $1 million.
It has to be uniform, and when it's not,
should be uniform. It's not. That's a problem.
And you've done a great job over the years proving that
Right.
that you look in these areas, and it's as clear as day. And there was a review commission who issued their recommendations right before COVID. And again, they need a whole mess of state legislation to do that. And the state's probably not too motivated to do that because they don't get that money. And who cares? If they're getting the revenue, they're not going to worry so much about it, even as your lawsuit makes progress.
Yeah, I mean, I think, that's one of the issues with the property taxes. You do pay it up front, and then you have to fight to get back what you're owed, as opposed to being able to withhold payment.
And it's based on the value. Right?
Yeah.
Ad valorem, is that what they call it in legal?
Ad valorem, yep.
They don't care. It's not based on your income.
No.
It's worth this. Sorry, it burnt down. If that was the case, I don't want to make a joke about a house burning down, but just more emphasis on taxable status state. It's like you still have to pay. Reminds me of in Goodfellas, and I talk about how you got to come up with police protection money each month. Place burnt down, too bad, pay me.
Oh, okay. Well, likening it to Goodfellow now, huh? Okay.
Goodfellas is a great movie.
Right.
It's a Sicilian in me, but people worry, what's going to mean for the housing market, and obviously it's going to reduce demand for luxury apartments. We don't know by how much, and luxury homes. But it's funny what people think of luxury. For one thing, a lot of people may have bought a brownstone in Brooklyn or something in Queens, 50 years ago for $10,000 that has now reached the threshold where it could be worth $5 million, and they could be living full-time somewhere else. This does have impacts, but to me, it's the economic impact to the city. And we did some work with consulting firms to kind of prove that even if you get something from this tax, the amount of other revenues you're going to lose are going to dwarf it, to an extent. And what does that mean? Well, if I'm a developer and I cater to Pied-a-terre owners, am I going to build as many buildings? Or am I going to build as many units? If I don't, then that's a loss of thousands of construction jobs, all the income tax those workers would pay, the property tax the building would pay, the transfer tax and the mansion taxes, all of that stuff that goes into building a building and that has a permanent effect on the area goes away, and jobs that are needed go away.
So I think, one of the things that you said at the start of the program is that it's a 5-year, bill, right? It basically sunsets in 5 years. And part of the reason why at least that part was asked for is that if you say a bill sunsets, it invites the kind of conversation that you're talking about. It gives people an opportunity to look and say, what has been the impact of this and whether or not it's causing the harms that you want. So if it had been, adopted in perpetuity, then, I certainly would still have those concerns. But I think there's an adjustment period. It's 5 years, and let's see kind of where we are. And I think the more one's able to document those changes, the less likely is that it gets renewed.
Right.
So that's the hope. Again, I'm not saying that's what's going to happen.
See, the other side of that is it's just more uncertainty 5 years from now.
Yes, it is. However, at least if it's based on actual information,
Let's hope
people can either adjust or not.
We had a lot of fun making those presentations to certain politicians.
Yeah, we did. And people were actually responsive in some ways.
Except one very notable exception, but who didn't care anything that we said. But we had cookies at that meeting, if you remember, the certain meeting
Absolutely.
with a very prominent developer. But is there anything we forgot, Martha, that we have to say as we wrap this great episode up? Other than we're hungry for lunch now, because this makes
no.
us...
I just again think and want to encourage people to get you scenarios. Now, don't give us the 1 in 10 million chance that this is going to happen, but scenarios that they're encountering. And I think it's going to be important to make sure that the Department of Finance is aware of those, and all of the policymakers who thought that this was a good tax to adopt, they need to be aware of the scenarios. One other thing, right now, it looks to me like there are some not-for-profits that might also be subject to this tax because or I should say surcharge, because the surcharge isn't looking at exemptions. So if there are, any, churches who have rectories or anything that's over $5 million in a 1 to 3 family, they've got to be concerned as well. Universities, if they have any faculty housing that's actually above this threshold. So really kind of important things to sort of be on the watch for.
And for you agents out there or buyers or sellers, you need legal advice here. This is not something that you can just assume, well, this makes sense, or because the thing about the rules that stood out to me when I was reading them was the penalties for providing false information could be up to 50% of the tax that you're required to pay.
Right.
So there are serious consequences to, making mistakes or misleading or outright lying. So, I always tell people, don't come to an economist for legal advice. Probably not for economic advice too much either, but this is why lawyers exist, and that's why you have these professionals. Just like as a real estate agent, you're a professional, and that's why you've been hired by your clients. So let's all stay in our lanes and go by what we do know. As we get more information, we will share it. I guess the next big part is when these letters actually start going out. And I wonder if those are going to be public. I guess not. But when the January bills come out, then it will be public.
I would imagine that they are going to have to make it public. I mean, one of the suggestions that we certainly have, or we were drafting, is from a transparency perspective, they should be either adding columns to the assessment roll that tell us, we've determined this is the primary resident. This one is actually going to... even the shares, how many co-op shares they think there are, and these units, they have to provide a lot more transparency so people can actually double check to see whether or not they're doing this the right way. And that should really be a requirement.
Well, thank you so much for coming on the show. Again, it's been a while since we've had you, and we're going to have you on more frequently because I get tired of Scott and Shar after a while. They're all right guys, but
promises.
Well, I did promise you lunch, and we will be heading to that shortly at Canaletto, my favorite place to eat in New York City.
Excellent.
Ray loves the mushroom pasta. He doesn't eat
Good
meat, but we're going to be eating meat when we get there.
All right, sounds good.
But thanks again. Thanks to
for
Ray and
having me.
Lena.
Yep.
Thanks to all of our sponsors. And of course, to all the listeners and viewers out there. We love each and every one of you. Have a great championship week celebrating our beloved New York Knicks.
What do you really need to know about buying or selling a home? First, it's serious business. And it's complicated. There's a lot of money on the table, and emotion too. You need an agent who knows the ropes. So, whether you're buying or selling your home, work with professionals who have a mastery of the craft.